Wanted to take a look at options trading strategies. Today I'm looking at straddle options. What are straddle options? I have a whole series where I do options trading strategies for beginners, an entire series that I'm putting together. And every single day, what I'm doing is I'm walking in and I'm looking at a straddle at the money, 0 DTE, and asking the question, if you just mindlessly put on a straddle position at the money, SPY stock, 0 DTE, after the market opens, basically within the first 5 minutes, how would you perform? Now, I have a bunch of data from last week. I'm starting to catch up on some of the videos I need to put out, but we are going to answer the question on this straddle. Now, first, what is a straddle option strategy? You take buy a put and a call long at the money, same expiration date. Now, a strangle option strategy is different strike prices, put and call. Now, I am going to be looking at strangles. I don't really like strangles too much. I like to do overnight strangles when I know that we're going to get something big happen in the market, but they tend to be a little bit expensive. So overnight options like that tend to not work out because you really do need a pretty decent sized move within the market. Given that, let's take a look at this straddle option strategy. Let's jump in and we'll talk about option strategies for beginners. As I said in the intro, my options trading for beginners strategy is basically I'm looking at this one. I want to do about 100 data points and asking the question every single day, what happens if you do buy a straddle at the money call, at the money put, 0 DTE, SPY stock. Now this is from last Wednesday. The stock market opened up. It was I think reference was 526, and this is after we got our inflation data. And I was pretty sure that this probably wasn't going to work out. As it turns out, it worked out quite well. Let's move forward and look at, you can see the big move that we had right at the beginning. Now, I'm two things. Number one, military, so it's all in military time. Number two, I'm in mountain time. So at 0630 my time, that's when we got that news release. Now, the 2 days previous to this, Tuesdays was break even, Wednesdays was profitable over top of the cost of what I paid for both the put and the call. You're buying a 0 DTE option, put and call, both at the money. And I'm pretty sure it was 526 even. Reference was 526.10. The call and the put, you can see, amounted to $2.38. So the calls were over puts when it comes to premium, but reference was higher, 526.10 for the calls. But you can see there was a bit of a premium. 238, that's pretty high. Now, looking at the previous 2 days, they were trading the put and call straddle at the money, 0 DTE was about $1.72 to $1.82 for that day on Monday and Tuesday. Wednesday, of course, this is up 50 cents more. That's a huge jump. Now, I ask the question every time I'm looking at the options. I ask the question. So 238 is a pretty big dollar amount to see movement. What is the likelihood that we see a move of $2.38? I've got data going back 1960s, 1950s, not even sure. And I ask the question when it comes to, on a percentage basis, what are the broad movements we see? You get the open, there's a movement from the open to the high and the open to the low. What are the ranges? And as you can see, the open to the high and the open to the low are about 0.4%. Then you have the range between the high and the low. Then you have the close to the high, close to the low, and then the distance between the open and the close. On average, you see a move of about 4.4%. The problem is, if you look at these data points, the open and the close are about the same as the range from the open and the high. These are averages. And what's happened is I have so much data points that the averages are starting to meld together. Looking at the previous 100 days, however, can we clear the 238 and still be profitable? This particular day, it just happened, yes. Would I normally put this trade on given such a high price of 238? No, I would not. But it just happened to work out. And if you break these down, you can see that the high to low range in total was 428. But the market rarely opens up at one price and then just keeps going and then closes at the either high or low, giving you such a big range. But these data points give me an idea as to the percentage of opportunity that I'm actually going to be profitable in any particular trade like this. 238 is real rich though. As it turns out, from the 526.10, 238 is 528.48. We cleared 529.50, but you have to get out about 30 minutes prior unless you have enough money to take a whole SPY stock, 100 SPY stocks. I cleared out the position. Not only did I want 238, I also wanted 238 plus 50 cents on top of that because I want some profit, of course. It still cleared that. I was able to make that profit on Wednesday. This is an outlier kind of move for the day. You're not going to see big moves like this moving in one direction. But the market felt as if that the information that we got was enough that the Federal Reserve, yes, can lower interest rates soon. I do not believe that the market is correct. I said this back in October, November, December, that there's no way the market walked into the year saying, oh, we'll get 6 cuts. I thought those people were dreaming beyond belief. Well, it's already May, and we're looking to see if we get any cuts before September. September has priced a shift in the rate cuts from prior to this day from like 0.38 up to 0.52. So they're giving September rate cut a 50-50 at this point. So the 6 cuts was ridiculous. Given that, the fact that we probably will see some cuts eventually, November, December, January, February, March, going into 2025, the market's already gearing up. I think that the market's getting a little bit ahead of itself, and I think we're going to see the stock market in general shift back downward because the rate of growth. But that has nothing to do with the options for 0DT at this time. Regardless, that's why we got such a big move on Wednesday, was because this was sort of a celebration that, yeah, the market's finally right. I still don't think the market's right, but we'll see how that plays out. I'm going to start looking at spreads, looking at credit spreads specifically, because I believe that the market is overpriced. What I'm going to start doing on my stock option strategy for beginners, I have a playlist down there that I'm going to be putting all these into, option strategies for beginners. What I'm going to be doing is looking at credit spreads, 0DT, selling near-term call, buying a much higher priced call for protection. You typically bring in about 12 cents, and what you're looking for is no movement whatsoever. I'll probably do overnight on these because you get a little more juice out of these options. So I'm going to be continuing looking at these straddles. I'll look at some strangle stock option strategies, and then I'm also going to be looking at credit spreads. And the question is, can you after a certain period, like specifically this day with such a big move higher, is that an opportunity to step in, then do a credit spread option strategy? My thinking is yes, that we probably don't see much movement beyond this because of such a big move, that you see the market fade a little bit. So make sure to hit the like and follow button down below, and you can follow along with option strategies for beginners.